Welcome back to The Takeout. Oil prices rose more than 7% to a two-week high after President Trump said the Iran ceasefire is over. Brent crude is trading around $80 per barrel. West Texas Intermediate trading about $75 per barrel. There was also uncertainty on Wall Street. The Dow fell nearly 600 points. The S&P 500 and NASDAQ, well, they stayed mostly flat. Joining me now, Joseph Majkut, Director of the Energy Security and Climate Change Program at the Center for Strategic International Studies. Joseph, great to have you here. So I've been reading about this, and as I understand it, during the war and the instability that ensued, when oil was not flowing through the Strait of Hormuz, the United States and others so positioned drew down their oil reserves and their own strategic petroleum reserves.
Yep.
Did that buffer things, and can we still do that?
You know, when the Strait of Hormuz closed late February, early March of this year, it was an enormous shock to the system. And a lot of analysts looked at that and thought, okay, prices are about to skyrocket. And prices went up, but in an attenuated way.
Right. They didn't go to 150 or 200, which some analysts thought was possible.
And you've got the explanation for that right on the head. We went into that crisis with record high inventories in commercial stocks. I mean, this is oil and products in tanks, and tankers floating on water. And we went in with record highs. And, you know, US EIA says we ate into those about 5 million barrels a day at the depth of that crisis. So if, you know, we ended when the Strait of Hormuz reopened with depleted global inventories, and then now if we're facing, again, closures, we're going to have a lot less cushion than we started with last time, and prices will reflect that more quickly.
Meaning they'll go up more quickly if, in fact, this is a prolonged process of closing down the strait because there's just not as much to draw down on to buffer the supply-demand
The right
equation.
way to think about it is one of the things that kept the crisis from being a bigger economic crisis or political crisis was these large stocks and buffers. We ate into those. And so now if you have another big problem getting oil out of the strait, we're going to have shortages and price increases.
I have read also, Joseph, that after this event, starting February 28th, oil markets and oil trading will not be the same. It's not going to return to what it was and the assumptions about the Strait of Hormuz that existed before February 28th. And new adaptations, new supplies, new trading routes will all be explored.
Sure, we'd struck a balance that had held for 40, 50 years, that the U.S. was protecting the freedom of navigation through the strait. There were flare-ups during various Gulf conflicts, but never a closure like the one we saw.
And Asia banked on it, Europe banked on it, and we, to a certain extent, banked on it.
Exactly right. Over the years, you know, we were heavily reliant on Middle East oil. As the shale revolution took over, our share of that in terms of trade went down. But you saw concentrated import dependence in East Asia, Southeast Asia. When the crisis struck, those were the places that felt it first. The U.S. was relatively insulated, but because oil is a globally traded commodity, we can't escape the price impacts.
And very quickly, when the president said, as he did late this afternoon, whatever happens in Iran is not going to last long, that was a means, it seemed to me, of him signaling to the oil markets, don't get too fluttery. It won't be a prolonged issue.
The president's been doing that this whole time. Markets still are looking, you know, they're not pricing in a closure yet. They're still sort of looking at a less open strait.
Right.
We'll have to watch what happens the next 24, 48 hours.
As we have been continuously. Joseph Majkut, great stuff. I appreciate it coming in. Thank you very much.